Have you ever opened a cryptocurrency chart, seen several green candles, and assumed the price must keep rising? Or perhaps one large red candle appeared and you thought the market was about to collapse. That is one of the first misunderstandings beginners face. Candle colors are useful, but they do not predict what happens next by themselves. In this lesson, you will learn how to read green and red candles, what their bodies and wicks reveal, why the candle close matters, and how to interpret candles within the wider market context. We will also examine realistic hypothetical Bitcoin examples, common mistakes, confirmation methods, and connections to TradingView and PineScript. This lesson is for education only. Cryptocurrency trading involves substantial risk, and no candlestick can guarantee a profitable outcome or future market direction. Let us begin with a simple definition. A candlestick is a visual summary of price activity during a specific period. Think of it as a short report describing what happened during one chapter of the market. On a 1-hour chart, every candle summarizes 1 hour of trading. On a 15-minute chart, each candle represents 15 minutes. On a daily chart, one candle summarizes an entire day. Most chart layouts use green for a bullish candle and red for a bearish candle. Bullish means the price closed higher than it opened. Bearish means the price closed lower than it opened. A green candle therefore tells us that buyers achieved a higher closing price during that period. A red candle tells us that the market finished that period below its opening price. Notice the wording carefully. A green candle does not mean every transaction during the period moved upward. A red candle does not mean price moved downward without interruption. Price may travel in both directions before the candle closes. Every standard candlestick contains 4 essential prices: the open, high, low, and close. Traders often shorten these terms to OHLC. The open is the first recorded price of the period. The high is the highest price reached. The low is the lowest price reached. The close is the final recorded price when the period ends. The thick section between the open and close is called the body. The thin lines extending above or below the body are called wicks, or shadows. On a green candle, the opening price is normally at the bottom of the body, while the closing price is at the top. On a red candle, the opening price is at the top of the body, while the closing price is at the bottom. The upper wick extends toward the candle's highest price. The lower wick extends toward its lowest price. These relationships remain the same regardless of the candle's color. Here's how a candle develops step by step. Imagine a new 1-hour Bitcoin candle opens at a hypothetical price of $60,000. This is an example, not current market data. During the hour, Bitcoin rises to $60,600, falls to $59,800, and finally closes at $60,400. The open is $60,000. The high is $60,600. The low is $59,800. The close is $60,400. Because the closing price is above the opening price, the completed candle is green. Its body covers the distance between $60,000 and $60,400. Its upper wick reaches from $60,400 to $60,600, while its lower wick reaches from $60,000 to $59,800. Now imagine the next candle opens at $60,400, reaches $60,500, falls to $59,900, and closes at $60,050. That candle is red because its close is below its open. The body extends between $60,400 and $60,050. Its wicks show the higher and lower prices tested during the period. This is the mechanical meaning of candle color. Interpretation requires additional context. A long green body can show strong upward movement during that period because the close finished well above the open. A long red body can show strong downward movement because the close finished well below the open. A small body shows that the opening and closing prices were close together. This may indicate temporary balance, hesitation, or reduced directional progress. It does not automatically mean that a reversal is coming. Long wicks provide more information about the path price traveled. A long upper wick shows that price traded higher but moved back down before the candle closed. This can indicate rejection of higher prices, profit-taking, or increased selling activity. However, it does not prove that price must fall next. A long lower wick shows that price traded lower but recovered before the close. This may indicate rejection of lower prices or renewed buying activity. Again, it is information rather than a guaranteed reversal signal. A candle with a very small body and prominent wicks may resemble a doji or spinning top, depending on its exact proportions. These formations often suggest indecision, but their importance depends heavily on where they appear. For example, a small indecision candle in the middle of a sideways market may add little useful information. The same type of candle after an extended trend near an established support or resistance area may deserve closer attention. Support is an area where buying interest has previously helped slow or stop a decline. Resistance is an area where selling interest has previously slowed or stopped an advance. These are usually zones rather than perfectly precise prices. Suppose Bitcoin has repeatedly reacted near a hypothetical support zone between $58,800 and $59,000. Price returns to that zone and forms a red candle with a long lower wick. The following candle then closes green above the red candle's high. A reasonable interpretation is that lower prices were rejected and buyers showed additional strength through the next candle's close. This does not guarantee a rally, but it provides more context than simply buying, because one candle turned green. An incorrect interpretation would be, the candle is green, so Bitcoin must continue upward. A green candle can appear during a larger downtrend, immediately before resistance, or during a short-lived recovery. It describes one completed period, not the future. The surrounding trend is therefore important. A trend is the market's broader directional behavior. An uptrend generally forms higher swing highs and higher swing lows. A downtrend generally forms lower swing highs and lower swing lows. These swing points are noticeable turning points in price. A sideways market may move between support and resistance without maintaining a clear direction. A green candle that continues an established uptrend may have a different meaning from an identical green candle pushing into major resistance. Likewise, a red candle in a downtrend differs from a red candle briefly pulling back within an uptrend. Time frame also changes the interpretation. A green 5-minute candle may exist inside a large red 1-hour candle. Both are accurate because they summarize different periods. Short time frames reveal more detail but often include more random movement, sometimes called market noise. Higher time frames generally summarize broader price behavior. There is no universally best time frame. It should match the trader's method, holding period, and ability to manage risk. What matters is using it consistently and understanding how it relates to higher time frames. You should also distinguish a developing candle from a closed candle. Before a period ends, price can move above and below the open many times. A candle that currently appears green may finish red. Waiting for the candle close can prevent decisions based on an unfinished shape. It cannot remove false signals, but it confirms the candle's final OHLC values. Volume can provide additional context. Volume measures the amount of trading activity recorded during a period. A wide candle accompanied by relatively high volume may show stronger participation than a similar candle on unusually low volume. Volume must still be interpreted carefully. High volume can occur during continuation, panic, liquidation, news-driven volatility, or a battle between buyers and sellers. It is supporting evidence, not automatic proof of direction. Volatility matters as well. Volatility describes how widely and quickly price moves. During highly volatile conditions, candles and wicks may become larger. A candle that appears unusually strong in a calm market may be normal during a volatile period. This is why experienced analysis compares candle size with recent candles instead of judging it in isolation. Traders may combine these ideas into a simple decision process. First, identify the time frame. Second, observe the broader trend or market structure. Third, mark nearby support and resistance zones. Fourth, allow the candle to close. Fifth, compare its body and wicks with recent candles. Sixth, look for confirmation from following price action, volume, or another relevant method. Confirmation does not make a trade certain. It helps create defined conditions that can be evaluated consistently. On TradingView, you can select a candlestick chart, change the time frame, and inspect the open, high, low, and close values. You can also adjust candle colors, so do not assume that every chart uses green and red. Always check the chart settings. PineScript allows these candle rules to become objective conditions. For example, a script can define a bullish candle using the condition that the close is greater than the open. A bearish candle can be defined when the close is less than the open. A script may also compare body size, wick length, volume, trend filters, or support-related conditions. It can display an indicator, create an alert, or test a strategy on historical data. However, coding a green candle as an entry rule does not make it effective. Backtesting is needed to evaluate how defined rules performed on historical data. Historical performance still cannot guarantee future results, and realistic testing should consider fees, slippage, market conditions, and false signals. Let us review several common beginner mistakes. The first mistake is treating every green candle as a buy signal and every red candle as a sell signal. Candle colors report past movement within a period. They are not complete trading systems. The second mistake is ignoring the candle's location. A strong green candle directly below resistance may carry different risk from one that has closed above resistance with confirmation. The third mistake is acting before the candle closes. The body, color, and wick can change significantly while the candle is developing. The fourth mistake is ignoring time frame differences. A bullish pattern on a very short time frame may be moving against a much larger bearish structure. The fifth mistake is focusing only on color and ignoring the body and wicks. Two green candles can communicate very different price behavior. The sixth mistake is assuming a long wick guarantees a reversal. Price can test the same zone again or continue through it. The seventh mistake is using too many indicators to force agreement. More indicators do not necessarily produce better information, especially when several measure similar data. Finally, never allow a colorful candle to replace risk management. Before entering a position, a trader should identify invalidation. Invalidation is the condition showing that the original trade idea is no longer behaving as expected. A stop loss may be planned around that invalidation point, but it cannot guarantee the exact exit price during gaps, rapid volatility, or poor liquidity. Position size should be calculated so that a stop does not expose the account to an unacceptable loss. Risk-reward compares the amount at risk with the potential reward. It is useful for planning, but a favorable ratio does not mean the target will be reached. Traders must consider both the potential outcome and the probability of the setup. Avoid excessive leverage, because leverage magnifies losses as well as gains. No green candle is strong enough to eliminate trading risk. Let us finish with the 5 most important lessons. First, a green candle closes above its open, while a red candle closes below its open. Second, every candle contains an open, high, low, and close, represented through its body and wicks. Third, candle color describes what happened during one period. It does not guarantee what happens next. Fourth, trend, time frame, support, resistance, volume, volatility, and candle close can provide essential context. Fifth, consistent rules, testing, and responsible risk management matter more than reacting emotionally to a single candle. Follow PineScriptLab for more beginner-friendly lessons about cryptocurrency trading, TradingView, PineScript, indicators, strategies, alerts, backtesting, and trading automation. In the comments, tell us which topic you want explained next. Candle wicks, support and resistance, market structure, or candlestick patterns.